the Magnificent Seven stocks have seen their PE ratio more than doubled, rising from around 12 times earnings in 2012 to 30 times today. And compared to the broader market, these companies have steadily grown more expensive over the past decade, widening the gap between them and the rest of the S&P 500, which currently trades at 20 times earnings. If we break it down by individual stocks, the picture becomes even clearer. Nvidia is currently trading at about 30 times forward earnings, and Tesla is trading at around 190 times. And again, for many investors, they echo the late 1990s, where companies like Intel were trading near 40 times earnings, and Cisco reached 196 times. But even with valuations stretched and stock prices sitting near record highs, investors are still piling into the same megacap tech names. According to Bank of America's Global Fund Managers Survey, being long on the Magnificent Seven remains the most crowded trade in the world. More than 40% of global fund managers now saying being long these tech names is the single most popular position in markets today. There are two possible reasons that could explain this. The first reason is the fact that these companies have never been this profitable. This chart shows the profit margins of the Magnificent Seven, which have climbed sharply from around 18% to nearly 27% since the launch of ChatGPT. When we compare this to the rest of the S&P 500, we can begin to understand why these companies trade at such a premium. While the broader market's profit margins hover around 12%, the Magnificent Seven are generating more than twice that level of profitability. Profit margins are one of the best leading indicators of future growth. When margins expand, it tells us companies have pricing power, operational efficiency, and the ability to reinvest in what's next. On top of that, even though prices have surged, the earnings of these companies have also grown rapidly. If we zoom out to include the 1990s and look at the overall technology sector, we can see that since 2020, their earnings have grown by around 165%, far outpacing the 100% growth seen in the 5 years leading up to the 2000 dot-com crash. For many investors, that kind of performance helps justify the higher valuations. And from this perspective, one could argue that while the market looks expensive, it's not yet in bubble territory as prices are still supported by improving fundamentals. Yes, valuations are high and market concentration is at record levels, but for now, profit margins and earnings growth are keeping those prices in check.